Welcome again to another class. Today, our target is to use this makeup time to finish up IAS 37 and also to start and finish IAS 10. If we can achieve that, then we are good. We are very good. So let's see if we will be able to get there. Um, Note that this is a combined class, and for my SBF students, I would be doing some revisions because I've not gotten to some questions that I solved with you yesterday for some other people that are present here today. So it's going to be a revision for you. So firstly, we started looking at provisions that is governed by IAS 37. And see, the major issue around provision itself is the meaning of provision, is how do we account for provision? Because when you look at the definition of what provision is, it says that provision is a liability of uncertain timing and amount, which means that this amount, this item, we don't know when it will occur, and we don't know how much it is. As of now, we don't know. And because of that, IS 37 came with, to a large extent, a strict guidelines on how you recognize provision, and which, of course, you have to know for your exams. We started looking at recognition of provision, and I told you there are three recognition criteria. First one, which is present obligation. There has to be an obligating event that can either be a legal obligation or constructive obligation. Second is that it must be probable that there will be an outflow of resources embodying economic benefit. Along the line, I think it was Femi that asked the question yesterday when we were solving a question, and I needed to explain again that this second part, when you say it is probable that an outflow of resources will be required to settle the obligation, what this is talking about is that there is a 50% chance that we will pay money. There's a 50% chance that we will pay money. So if an event happens, then of course that shows, even if there is a 1% chance of, if something happened, if an event has occurred, right? That already shows that we might have to pay money. That already shows that we might have to pay money. But what this second point is talking about is that it is probable, meaning it is more likely than not, meaning that there is over 50% chance that we would have to settle. There will be outflow of resources. And of course, this money that we want to use to settle this obligation, we must be able to measure it reliably. So these three recognition criteria, you have to know it because you will always need it. Then we solved a lot of questions. I brought up this question early enough just for you to understand that as far as provision is concerned, you see, this point one is so key, is the important direction, is what directs you on whether you would recognize a provision or not. The first thing you should look out for is there an obligating event? Do we have an obligation? That's the first thing. Then others are secondary. That, okay, we'll pay money. Okay, do we know how much you will pay? Those are secondary. The first thing is that present obligation. And these questions really helped us in being able to identify that. And we saw some questions like this first one where they were just planning a reorganization. There is no obligation. We saw another one where the government came up with a legislation that companies that have high rise would have to change their glasses. And this company, and they said that, okay, oh, they will need to comply within 5 years. We said there is no obligation. Because the company can decide to change his mind and sell those high rise. So he doesn't have any obligation. He doesn't have to make a provision. Then when we came to instances where a company has made a widely published policy and he has a record of honoring that policy, even though there is no environmental legislation, we said there is an obligation, which is a constructive obligation, and would have to make a provision in that case. Of course, I caution you that even though we were emphasizing that, okay, is there a present obligation? Is there no present obligation? Note that before you can recognize a provision, the other two must also be present, because we need these three to be present before you can recognize a provision. But we're just using these questions to learn and get used to all of this. Then we looked at some other ones. Then quickly we went on to another very key part when it comes to provision, which is measurement of provision. And the way we measure provision, considering the fact that provision transactions that we make provision for are transactions that we don't know when they will occur. We don't even know how much we'll spend. Then, how do we then know how much we put in our books? You have to make that provision. We said that you should measure it at the best estimate of the future expenditure required to settle the obligation, the best estimates. So the standard admits that, yes, the best you can do is to make an estimate, because we are talking about the future here. It's money we will spend in the future. And in some cases, it's much, much later into the future. So it's not possible for us to know with certainty how much we're going to spend. So to measure it, you look at the best of the estimates that you of the future expenditure to settle this obligation. And you see, this best estimate, you say that let your judgment guide you. And this your judgment should be supported by past experience of similar transaction, or you could use expert advice. Yes, you could use expert advice. Like the case of where you have to clean up or where you have to remove your asset from a site in the future, and you have made a published policy that you will do that, you can get an expert to give you a quotation that if I want to do this in the next 5 years, how much will I spend? Yes, that could be a best estimate. So when we are saying best estimate, it doesn't mean we just sit down and make a random and just come up with a random figure. No, should be supported by past experience, or you use expert advice. And also, when you're measuring provision, we know you have to make estimates. Then you need to look at what you're making provision for, which are usually an obligating event. You see, this event could be a single event, just one event, like the case of you want to remove your machine from a site in the future, or you want to restore a site to its original condition, or you want to it's a single event. You see, to make estimates of provision in such cases, you just focus on the most likely outcome. The most likely outcome. And the examiner will, meaning that the examiner can give you like two or three outcome. Then you look at, okay, which one is more probable? That's the most likely. Which one is likely to be the outcome? It could be multiple events. Typically, when a company gives warranty to its customers, and there are a lot of events, a lot of customers can come and return goods. That's multiple. So you would be using expected value in that case, because you would then have to do some probability that, okay, what proportion of them are going to return? Because it might not be all of them that would return. So you would do a probability of them returning. You would then use that basis to determine the amount. We solved one question yesterday. For my SBR student, I've solved more, but we did this. And this question is talking about, is a single event question, in the sense that the obligating event is that they want to remove accommodation blocks in the future after 2 years, and they're trying to make a provision for that. Then they looked at that, okay, with this removal, the outcome is that it could either be complex or straightforward. If it's complex, they say they will spend 4 million. That's the present value today. Of course, the amount will be higher in the future, but the present value of what they will spend in 2 years is 4 million. But if it is straightforward, they would have to outflow 2.6 million. But the entity says that there's a 60% chance that it will be straightforward. So that means the most likely outcome is that it's going to be straightforward. That means the provision we will make is 2.6 million. That's how single event works. You would focus on the most likely outcome. Then there is another question. This one looks at Alibat that sold 5,000 units in the year. And it says that sales accrue evenly over the year. When we say sales accrue evenly over the year, we mean that we sell equal amount of quantity. We make equal sales every year of the month, every month of the year, I mean. That's what we mean by when we say sales accrue evenly over the year. And they say that it estimates that for every 50 items sold, then 10 will require small repair at a cost of 15 naira each. 5 will require substantial repairs at a cost of 200 naira each. And 5 will also require major repair or replacement at the cost of 400 naira each. They said on average, the need for a repair becomes apparent 6 months after a sale. What is the amount of provision that will be recognized? Now, looking at this, you would agree with me that a lot can happen in the sense that we sold 5,000 units and probably there is a warranty that they can return when there are defects on the goods. And the question gave us some estimates of the money that we might likely pay or the repair we might likely do. Because they said that for every 50 sold, 10 require small repairs, 5 require substantial repairs, 5 will also require major repairs. So from there, we can get probability of the money we will spend, right? We have to get probability. So the series of events is that we could have small repairs, we could have substantial repairs, we could have major repairs. So if it is a small repairs, we say only 10 will require small repair for every 50 that we sell. Then we do 10 divided by 50, of course, times 100 over 1. When you do that, then you should be looking at around 20%. 5 for every 50 sold will require substantial repairs. Then we should be looking at that's around 10%. And also 5 will also require so major repairs for every 50 also sold, and that's also 10%. So now the number of items that will require repairs, how many are we now looking at? Okay, so is going to be, ordinarily, I should have done 20% times 5,000, right? 20% of 5,000 should require small repairs, but it's not all these 5,000 that would require repair this year, because this sentence has changed the dynamics. This sentence told us that on average, the need for repairs becomes apparent 6 months after sale, which means that if we sell in January, the need for repair will become apparent 6 months after, which is in July. All the sale we make in February, repair will become apparent, that's around August, like that. That means any sale we make up until June, those are the ones that would require any sort of repair this year. That is, any sale we make from July would not require any repair this year, but next year. For that reason, the item that we're going to consider is not 5,000 anymore. It should just be items that we will have sold from January to June. And since the question told us that sales accrue evenly over the year, which means that we sell equal quantity of goods every month. So if we had sold 5,000 in a year, that means for the first 6 months, we will have sold half of that, which is 2,500. So the portion that we need to bother ourselves on as regards occurrence of repairs is just on 2,500 goods. So out of these 2,500, 20% will require small repairs. That is 500. Again, out of these 2,500 goods, 10% will require substantial repairs. That's 250. Also, out of these 2,500 goods, 10% will also require major repairs. That's also 250. Now, all the amount of provisions we are making, or how much are we going to be spending? What's the future expenditure? Now, for small repairs, there are 500 items that we have identified, and each of them would cost us 15 naira to repair. So we are looking at 15 naira. So when we do 500 times 15 naira, then that's 25,000. Also, we also look at this other substantial repair. That will cost us 200 naira. So 250 times 200. How much is that? That's 50,000. And also, the 250 that will require major repairs is at 400 naira each for each of the major repairs. And 250 times 400, that's 100,000. When you accumulate everything together, the total repairs is 175,000. And this represents the amount of provision we are going to make for the year. That's the solution to this question. Do we have any question? Now, the next one, it says Alexi Limited sells goods with a warranty under which customers are covered for the costs of repairs of any manufacturing defect that becomes apparent within the first 6 months of purchase. The company's past experience and future expectations indicates the following pattern of likely repairs. They give us the percentage of goods sold, the defects and the cost. What's the provision that is required? So this one, they have already given us the probabilities. So unlike this one where we had to compute it ourselves, so we're not computing it ourselves here. They already gave us that 75% of the goods would have no defects. 20% of the goods will have minor defects and would spend 1 million to repair them. 5% of the goods sold would have major defects. So provision here then becomes straightforward for us to calculate because it's simply for the minor, just do 20% times 1 million, assuming you put, and that would be 200. And for the major, that's 5% times 4 million. That's also 200. So the provision would make is simply just 400. It's just 400. Okay, so we are getting to where we want to be. We are not there yet, but this is just showing you how to use expected value. These two questions shows us how to use expected value to determine provision, while this first one that we solved exposes you to the most likely outcome. Where you have a single event, you just need to look at, okay, between the outcomes, which one is most likely to happen? And the estimate of our provision will be on the basis of that. Okay. Before we look at more questions, let me quickly mention few things. One is items that can affect estimate of provision. Okay, and you just need to mention this point because you are going to need them when we start solving more questions. Number one is time value of money. So usually when you want to determine your provision and the future expenditure is going to occur in more than 1 year time, meaning much later into the future, the determination of the estimate of that provision or how much you're going to recognize today would be the present value of that future expenditure. So if you are supposed to do a cleanup cost in the next 2 years, and you estimate that, okay, we're probably going to spend 100 million, the provision you make today is the present value of that 100 million. Okay, so time value of money can affect the estimate of the provisions you make. The second one that can affect the provision that you make is future events. Future events. So future events like probably maybe changes in technology can also affect the amount of provision that you make today. Because when you have a scenario where if there is, let's say you want to do a cleanup cost and next year there will be a technology that would make that activity of cleaning up easier and cheaper. That means that means you should reduce the amount of provision you're making today. If the question tells you that next year or in the next 3 years, there'll be a technology that would reduce the cost by 20%. So reduce your provision today by 20%. So future events can affect the amount or the estimate of provision. Another one is reimbursements. Reimbursements. So when you are making provisions for a future expenditure, it's possible that you might have taken out insurance, or there is a counterparty or a third party that you can get the money from, or that would return some of the money to you, or all of the money to you. It's possible. Okay, if you're supposed to spend 100 million, and probably let's say you have an insurance that is going to give you, let's say, 90 million. You see, that's 90 million. Don't offset it against the 100 million. You cannot offset. Okay, but you can treat that reimbursement as a separate asset, like an amount that you're expecting. So you are not going to offset it against the provision, but you are going to keep it as a separate asset. And before you can even recognize any amount as an asset, I mean, you have to be reasonably certain that you will get it. It shouldn't be. Please, can you hear me now? I think I went off.
Yes, we can hear you, sir.
Can
Okay,
hear you
good.
now.
Okay. We can hear you, sir.
Okay, good. These reimbursements should be recognized as a separate asset. A part of the question I will show you today, there was one that they talked about this reimbursement, but the reimbursement happened after, in fact, the reimbursement they say they will get, they were only sure that they will get it after the year end. Like, as at the time they were making the provision, there was no mention of reimbursement. They were not sure that anybody was going to give them reimbursement. So as far as that year is concerned, that reimbursement cannot be recognized as an asset, because as at the year end, they didn't know, that they were not reasonably certain that they will get the reimbursement. I will show you, but I will show you that question. But that's the principle around reimbursement. Another one is change in provision. You need to know that when determining provision is anything you estimate, you need to do is an annual estimate that you do. Just like deferred tax, you estimate it annually, that there will be changes year in, year out. And those changes in the estimate of your provision will then become an increase or a decrease in provision that you're going to recognize in profit or loss. Those increase or decrease, you're going to recognize it in profit or loss. I will also show you a question like that as well. And there are a lot of other issues that can affect, the list goes on and on. Also, there are some practical scenarios that we might have mentioned indirectly that you need to get used to. Number one is when you have future operating losses. Future operating losses. So when we say future operating losses, it means that when an entity knows that from the review of its previous performance and the present economic condition, it can see that it's going to make a lot of losses. in the coming years. So can then such a company make a provision for that future loss? No, no. Provisions cannot be made for future operating losses because there is no what? There is no present obligation. Where is the obligation? There is no obligation. You just feel you would make losses. You cannot now say that, okay, I'm going to make a loss of 100 million over the course of 5 years. So let me make a provision for that 100 million. No, you cannot do that. There is no present obligation. There is no obligating event that would warrant such provision. You don't just make provisions. No. Another one is future major repairs. So if you need to, if there is need to repair your assets in the near future for whatever reason, and you feel that you're going to spend so much money and you want to make provisions for that. Again, provisions cannot be made for future major repairs because there is no obligation. There is no present obligation here. So you cannot make provisions for future major repairs. So when that time comes and you incur the money, whatever money you spend, you can capitalize it as part of the cost of that asset, but don't make provision for it like that today. Another one is decommissioning costs. So, which is the cost of removal, dismantling, and restoring a site back to its original condition. And this is typically necessary where an entity has a contract or there's an environmental legislation in that country that they must do that, or they have made a published policy that they must do that. So in such cases, then there is a present obligation. So provisions are made for the commissioning costs. So you would always make provision for the commissioning costs. Another one is restructuring. Restructuring. So when we say restructuring, a company might intend to change the scope of their operation, either enlarge it or reduce it, or they could decide to change management, the people that control and direct the affairs of the company. That is also restructuring. And usually restructuring are plans for the future by the company. So and when they restructure, it usually comes with its attributable costs. Like in some cases, they might have to lay off some staff, do some redundancy and the rest. So those costs that will be incurred for such a restructuring, can they make provisions for it? So provisions can only be made for restructuring if the entity has adequately communicated its restructuring plan to the affected stakeholders. So they must have communicated it. If when they communicate, then in that wise, they would have either created a legal obligation or a constructive obligation. And another one is self-insurance. I just needed to mention this because they can ask you also. Self-insurance is a situation where a company decide to set money aside in case of future unfavorable events. So they decide to self-insure themselves, right? So can you then make provision for such? Can you then make a provision? No, you cannot, because there is no present obligation. It's just your own decision that you want to set money aside, that you will incur some cost in the future. So provisions cannot be made for self-insurance. That you're trying to insure yourself, you're trying to be safe. You're now saying, okay, I want to set money aside for some future costs that I might incur. No, you don't make provisions for such. You see, all of this is just to close some loopholes, because it's so easy for companies to use provision to do creative accounting, right? And the two of the popular way they use provisions, okay, ways that entities use provisions to create accounting or manipulate manipulate financial reports. Number one is something we call big bat provisions. So this is where a company makes a huge provision in the year where it has a high profit, or where the entity is experiencing an excessively poor performance. So we call it big bat provisions. So now the loopholes has been closed, because before you make any provision, we must see the obligation. Otherwise, you cannot just make provision for anything that you just, any plan you think you're making in the future, you then make. No. Before now, you see company making a huge provision in a year where they have made high profits, that they look at it and say, we are making a lot of money, a lot of profit this year. And probably maybe because they don't want to pay so much in tax, or they don't want to declare so much dividend, then they just eat that provision against the profits. Because provisions, by the time you credit provisions, you debit P&L. So they can make huge provision, or probably in a year where their performance is already excessively poor, that they are not doing so well at all, that it cannot even get any worse. They will just eat additional provision to it, that the performance is already bad. It cannot get worse than this. So that's a big bat provision. Another way is profit smoothing. Okay, so this is used to describe situations where an entity, where an entity provision positions recognition of provision at a time that is favorable to the company. So profit smoothing is, they would position recognition of provision when it is favorable for them, not when they should make the provision. So even if they are supposed to make provision of 100 million this year, They will just look at it. Our profit is not so good this year. Don't let us make the provision this year. Let's make it next year. So they are just using it to play around or to structure their profit smoothing. So maybe sometimes they will make a big one this year if their profit is okay and make small next year. All of these are ways in which companies use provision to create account, or they use it to manipulate their financial reports. So you see, this action then result in a situation where a company is overstating its liability, overstatement of liability, to result in a situation where a company is overstatement of profits, and of course, probably they will be overstating or understating each of these items as well. Okay, so those needed to be mentioned. Now, before we solve questions, when you have made provisions for the year, there are some notes you need to make in the notes to the account, right? So the important note is you need to show movement in the provision for the year by reconciling the opening and the closing provisions. So you show us movements in the provisions for the year. So you tell us opening, closing, movement, just like we do for deferred tax. You need to always show that in the notes to the report. And also, you need to do a description of, of the obligating events, description of the of the nature, let me say nature of the obligating events. So you need to let us know these provisions you're making, what what is the what is it about? You have to explain it to us. User needs to know. Another one is that you need to do an estimate of the timing when there will be outflow of resources. Because by the time you're making provision, to a large extent, you should be able to make estimate of when you would pay that money. And also, you need to explain the uncertainty surrounding the future expenditure required to settle the obligation. Okay, these are provisions that needs to be made. So this description of the nature of the obligating event is that you need to explain to us, is this provision you're making, is it relating to cleanup costs? Is it relating to the commissioning costs? You need to tell us what exactly are you making provisions for. That's what this second point is talking about. This one is that you need to be able to tell us, give us an estimate of when you actually pay the money. Is it next year? Is it next 2 years? And this last point is that you need to explain the fact that you're not sure about how much you're paying, because probably they have not agreed. Shall I explain the uncertainty around how much you're paying? Okay, all of these are disclosures you'll find in the notes to the account. So this is it about provisions. So let's solve questions. Then we can then look at contingent liabilities and contingent assets. And remember, this was the first question we started solving. So I think we should solve it again. So I have, who's going to read for us? Ifua or Femi? Who's going to give it a go?
Good afternoon, sir.
Yeah, Femi, good afternoon.
Question 3. Roman Limited prepare its financial statement in accordance with international accounting standards. On March 16, 2017, Roman Limited made a public announcement of a decision to reduce the level of emission of harmful chemicals from its factories. The average useful life of the factory on March 31st, 2017 was 25 years. The depreciation of the factories is computed on straight line basis, method and charge to cost of sales. The directors formulate the proposal for emission reduction following agreement in principle earlier in the year. The directors prepare detailed estimates of the cost of their proposals. And this shows that the following expenditure would be required: 60 million naira on March 31st, 2018, 60 million naira on March 31st, 2019, 80 million naira on March 31st, 2020. All estimates were for actual anticipated cash payment. No contracts were entered into until after April 1st, 2017. The estimate proved accurate as far as the expenditure due on 31st March 2018 was concerned. When the directors decided to proceed with this project, they used discounted cash flow techniques to appraise the proposed investments. The annual discount rate was 8%. The company has a reputation of fulfilling its financial commitments after it has publicly announced them. Roman Limited has made a provision for the expected cost of its proposal in the financial statement for the year ended March 31st, 2017, in accordance with the provision of IAS 37, provision, contingent liability, and contingent assets. You are then required to explain the decision of the directors of Roman Limited to recognize the provision in the statement of financial position as at 31st March 2017. B, compute the appropriate provisions in the statement of financial position in respect of the proposed expenditure at March 31st, 2017 and March 31st, 2018. Compute the two components of the charge to statement of profit or loss in respect of the proposal for in respect of the proposal in respect of the proposal for the year ended March 31st, 2018. You should explain how each component arises and identify where in the statement of profit or loss each component is reported. Now go.
Thank you very much. This is a 15 marks question. And they have asked it like 3 times. First, they could ask similar questions again. But for me, I think as far as provision is concerned, this is like the toughest question I've seen them asking. So if you understand this, then you would do well. The first time they asked it, I have the same question here. It was in May 2021. The solution they provided there was, they didn't provide the right solution. It was wrong. but I saw that when they asked it again, the suggestion solution in the Pathfinder was correct. So they did the right thing in the Pathfinder. That maybe some people noted it and they updated it. So the first part of the question says you should explain the decision of the directors of Roman Limited to recognize provision in the statement of financial position as at March 31st, 2017. So that means this A part of the question wants us to explain. So you're not supposed to calculate anything. And as read by Femi, the first paragraph is talking about that they want to reduce harmful emission in their factory. Okay, and a factory that has a useful life of 25 years. And usually, the costs of the factory, they depreciate it, and depreciation is charged to cost of sales. Now, this proposal to reduce, they made a proposal of the money they will spend.
Good afternoon. Long
They
time.
they made a provision, they made an estimate of how much they will spend over the next 3 years, because we're in 2017 now. So they estimate that they will spend 60 million next year, another 60 million in 19, another 80 million in 2020. And they said that all these estimates they are making is the actual anticipated cash payments. They will actually pay the money. So they signed the contract on 1st of April 2017, and they said the estimate proved to be accurate as at the end of 2018 was concerned. And they said when the director decide to proceed with the project, that they use discounted cash flow to appraise the proposed investment. They use a discount rate of 8%. And the company has a reputation of fulfilling its final financial commitments after it has publicly announced them. And the company made a provision for the expected cost of its proposal in the financial statement for the year ended 2017 in accordance with. Okay. So we're now asked to explain that are they supposed to make provision in respect of this? So you see, the decision by the directors to make a provision in March 2017 is correct. It's correct. And why is it correct? The reason that is correct is that in March 16, 2017, they made a public announcement that they want to reduce harmful. So they've already created a constructive obligation. Because if I want to judge by when the contract was signed, they didn't sign any contract on 1st of April. And they went to make a provision in March. If I want to judge by legal obligation, I would say they don't have any legal obligation until the beginning of the next year, which is 1st of April. But just because they already made a public announcement as of March 16, that goes to show that this company has actually been exposed to constructive obligation. So the decision by the director to make a provision in March 2017 financial statement is correct, because as at March 16th, this is March 31st, as of March 15, 2017, they already have a constructive obligation as a result of the public announcements they made. Additionally, the provision can be justified from meeting the recognition criteria as stated below. So number one is that there is a present obligation as a result of past events. Number two is that it is probable that an outflow of resources will be required to settle the obligation. Number three is that the obligation can be measured reliably. So they can make a provision. It's right for them to make a provision following from our explanation above. Now, the B part of the question says that we should compute the appropriate provision in the statement of financial position in respect of the proposed expenditure as at March 2017 and March 2018. So this is asking us to compute the provisions as at March 31st, 2017 and 2018. So at 31st March 2017, the provision would be the present value of this future expenditure. So we need to get their present value. And how do we do that? We will do year 1, 2, 3. So if this is 2017, that means the future expenditure in 2018 is in 1 year. The future expenditure in 2019 is in the next 2 years. The future expenditure of 2020 is in the next 3 years. So the cash flows involved now in, let me put it in thousands. So this is 60 million. This is also 60 million. This is 80 million. Like that. Then we'll then discount it, discounting factor at 8%. Then by the time we multiply the two, we get our present value. So if we do 1.08 raised to power 1, what would that give us?
0.926.
0.9 what?
26.
23. Okay.
6.
26. Okay, what about 1.08 raised to power minus 2?
0.857.
1.08 raised to power 3.
0.793. 0.794, I mean.
Okay. So what's the present value? Okay. What about year 2? 60,000 times 0.857.
1,420 naira.
50,
1,420 naira.
like this?
420.
Okay. Year 3?
63,520.
50 what?
63,520.
Because the
Yeah,
first
and
one
don't
is
forget that.
the first one is 560, sir. Yes, 560.
5.
Yes,
Okay.
correct.
Okay. So don't forget that these rates, because somebody is asking that did they give us in a correction. So they always give you, they have to give you in a correction. They give us an annual discount rate of 8%. Okay. So can you sum these three together?
7,500.
Okay. So this is the provision we are making in year 1, 2017. Who can tell me the double entry for this provision? How are we going to enter it in our books? What's the double entry?
Can I try, sir?
Yes, please.
Credit provision.
Sorry?
Okay, so we debit our P&L,
Okay.
and then we credit our provision for the for what we are providing for, sir. The credit provision account.
Okay. With how much?
170,500.
170,500.
Okay. You actually tried, right? But in this case now, since this provision is the event is that I want to reduce the level of emission of harmful chemical from our factories. So we are not going to debit P&L. We are going to capitalize it as part of the cost of the factory. We would capitalize it as part of the cost of the factory. So you actually debit the cost of the factory here. That's just the only thing that you got wrong here. So 170,500. 170,500. So if I'm to prepare my statement of financial position as at year ended 31st March 2017, this is how it will look like. Let me focus on the provisions alone. If I have non-current liability and also current liability. So I will have provisions. I will also have provisions. So for the current, it will be 55,560. For the non-current, to be the ones that are due more than 1 year, which is this one plus this. Can you help me add these two together?
114,940.
Yeah. But the current will be this one that is due next year. This one that is due next year. Not only that, in my statement of profit or loss for the year ended 31st March 2017, I also have depreciation, which is that 170,500 divided by the remaining useful life. How many years? 25 years.
25 years.
Okay. Divided by 25. So how much is that?
6,820.
6,000.
820.
Okay, 6,820. So that will be the depreciation since we're going to capitalize the cost. Now, at March 2018,
Wow. Is that did you get 114,940?
is the addition of this 51,420 and 63,520.
Okay, so
Those are
thank
the
you.
accounts due more than 1 year. So, as of March 2018, our provision calculation will change. We need to redo this. But now, in 2018 now, don't forget, is in 2018 we'll start paying this, the 460,000. That's when we incur the 460,000. So that means this 60,000 becomes year 0. And discounting factor raised to power year 0 will always give us 1. So this will be 60,000. Then this one becomes year 1. This one becomes year 2. We want to use the same discounting factor for year 1 is 0.926. Discounting factor year 2 is 0.857. So can you do me 60,000 times 0.926? Okay, don't worry. I think I can get it from here. That'll be 55,560. Okay, can you do 80,000 times 0.857? How much would that be?
560.
68,560. Okay, so can you add these three together? How much would that give us?
184.
120.
Sorry, 184.
120.
120.
120. From I can see your hand, but I have to finish this before you ask question. So now in 2008, our provision is now this. And the reason why this provision is now this, it's like it increased from this to here. You see, the increase in provision between 2017 and 2018 is as a result of time value of money. The result of time value of money. So, and if you look at it, last year, the value of 60,000, as of last year, we said is 55,560. But this year, the value of 60,000 is that 60,000. So the difference between this, that increase is inflation. That's time value of money. Time value. So that increase, the difference is inflation. The same thing, last year, the value of 60,000 for in the next 2 years is 51,420. But if you look at it now in 2018, it has also increased like that. So instead of doing it separately, just look at the totals. So that difference of 184, 120 minus 170, 500. Can you give me the difference?
13,620.
13,620. Okay. So this amount will be treated as a finance cost in the statement of profit or loss. And it can also be calculated as if you do 8% times the opening value of that provision, 170,500. Can you give me the figure?
That since is 14.
40.
13,640.
Okay. Probably approximation differences. That's one thing that will be as a result of approximation, but that's another way of calculating it. So that difference will be treated to P&L this year. So if you don't want to do all of this, which doing this shows understanding, another alternative way, a shortcut way of doing this is knowing that going forward, you'll be unwinding the discounts with this 13,650. That is, you'll be doing like a debit to finance cost of that 13,620 or 640. Let's do 620. This one is more detailed. Then you credit provisions with 13,620 every year like that. So note that in March 2018, 60,000 will be settled in respect of the future expenditure, which means that we need to credit bank with that 60,000 and our provisions by 60,000. Okay. So if you want to prepare our statement of financial position now, as at year ended 31st March 2018, under my current liabilities, I will have provisions. And under my current liabilities also, I also have provisions. So if you look at from this table, in year one, what my liability is that I have to pay next year is now 55,560. That's the current. The liability that I have to pay in the next 2 years is 68,560. 68,560. And my statement of profit or loss for the year ended 31st March 2018. Now I have my finance costs as 13,620. I also have my depreciation, which will be 170 divided by 24. Or just since it's straight line, it will just be the same
820.
the same amount, 6,820. So far for me, I think this is the most technical question I've seen on provision, because it require good understanding of a lot of things. I mean, looking at the fact that we need to do discounting first, And knowing that you need to capitalize that provision since it's relating to the cost of a factory, or since that emission reduction is for a factory. And also knowing that you will need to separate this provision into current and non-current, because I can separate that liability into year 1, year 2, year 3. If it's not a liability I can separate into years, then this is not necessary. But this one, I know how much I'm paying next year, next 2 years, next 3 years. So I know my current liability and I know my non-current liability. And also your ability to determine the right amount of depreciation. And that's why the question silently told you that the depreciation for the factory is computed on a straight line basis under cost of sales. If I want to finish the examiner, I will just put this one here as cost of sales, just for them to see that I have put it under cost of sales. And I can even do the same thing here. I put this under cost of sales, even though it's not really necessary, but I can just do that to show some oversabiism, but it's not really necessary per se. And again, in year 2, I was able to show some level of technicality as well by letting the examiner know that I now know that this first 60,000 now is now this year. Is this year will settle it, so it's year 0. Then the next one is now next year and next 2 years. Then that's recalculated my provisions for me. And I let the examiner know that I understand what happened though, that I've unwind the discounts, that this provision increased because of time value of money. And this amount will be treated as a finance cost in P&L. And I know that I can also calculate it by just doing 8% of the opening balance. It will still give me, if I add this to this 1750, it will still come and give me this. I show them the double entry just to let them know I know what I'm doing. And I noted that the first 60,000 will be paid this year in such a way that my liability is just this and this, because I'm going to settle off the 60,000 this year, which I showed them the double entry. Then I did my statement of financial position, again separating it into current and non-current. And I also show what goes to P&L, maintaining my depreciation on a straight line, and showing the finance cost to P&L as well. And that's the end of that question. Okay, Ufoma, now you can ask your question, please.
So I want to ask, what about the 60,000? Is it not still going to P&L? Then also, for the next year, let's say 2019, how are we still going to carry that the first 60,000, or we'll start from the second 60,000?
Okay, so I think I've answered your first question already. The 60,000 is already settled in the second year. I already mentioned that already. And secondly is that since we have settled this 60,000, it shows that our liability is just the addition of these two. So if I want to do 2019 now, if I want to do at March 2019, my provision will just be, I will do that finance cost first, which is, I know that the provision will increase by the finance cost, 80% times, can you hear me add this to? Informer, can you add this to? Because that's the provision for that year.
124, 120.
124, 120. So whatever you get, you just say whatever you get here, your provision is just the balance brought forward, 124, 120 plus whatever you get here as finance cost. That's your new provision, like that, for that year. So again, don't forget that they will settle 80,000 in the second year also. You remove that one too. That becomes the balance of your provision. Like at the end of the period, it's going to get to zero. Can you get me this one? Let me see. 8% of 124, 120. How much is it?
9,929 or 930 approximately.
Okay. So let's add it to this 124. So how much does this give us?
134,049 or 050 approximately.
050.
49. Okay, 050.
So this is the new provision balance for 2018. So we will pay, we'll settle 60K again. Settlement of 60,000 from the provision. So this brings the provision to, what's 134,050 minus 60,000. What's that?
740 and 49 or 74,050.
Okay. So this is the provision that will show in the statement of financial position. And this is my finance cost for that year. So at March 2020, again, my provision, I will just do my finance costs, which is 8% times 74,050. So how much is that?
1,124. 1,124.
It cannot be 1,124 now. When 10% of 74,000 would be like 7,000 something. It should be like 5,000 something.
5,924. 5,924.
5,924. So new provision balance is 74,050 plus 5,924. How much is that?
79,974.
974. So I can easily approximate this one to 8,000. I mean, just because I know that there will have been some approximation error. So settlement of the final 80,000 from the provision. So this brings the provisions to 80,000. So it's because of you I did all of this. Former, don't do it in the exam. Oh. So from here below is not required in the exam. It's just to answer former question. That's how I will leave it in your note for you. Okay, Yusuf, I can see your hand raised up.
Please, can you go down a bit? Thank you.
Yeah, thank you, sir. So my own question is around that depreciation for the second year. So since our provision amount has increased, is it not that we are going to increase the amount that we are going to use as base to calculate our depreciation instead of carrying
Good
the
question.
depreciation of
Yes.
28?
Yeah. So you have asked a very good question. So you see, in the first year, when we capitalized that, where is it? Yeah, when we debited this provision, so we debited provision with 170, we credited the assets with 170, we credited provision. So what was increasing is provision. The cost we have debited to the asset is not changing. It's just that 170,500. It's not going to change. So the depreciation, the base of depreciation is not going to change. So what is increasing, what we are changing every year is then the provision. But what is in the asset account is that initial sum. That's what we have. Assets, it goes to assets is on historical costs basis. Okay. So depreciation also will then be on that basis as well. I hope that answers your question, Jacob.
Yes, it does. Thank you.
Any other question? Okay. So if you understand that question, let's solve another technical one, which is this one. Femi, can you please read this one? This May 2025 dates.
Yes, sir. The chief accountant understands the guidelines for the preparation of financial statements, one of which is provisions of contingencies. In the course of the preparation of the financial statement, a sum of 200 million naira was captured under his heading. On further investigation, it was discovered that the 200 million was made up of the following: 20 million for court case involving a supplier, 70 million paid for advertisement rights, 50 million naira provision for future losses in business operation, and 60 million for judgment debt on appeal. Required advice on the appropriateness of the amount of 200 million naira captured in the financial statement. Compute the correct amount of provisions or contingencies if the 200 million naira recognized in the financial statement is wrong. 3. Discuss the treatment of the previous entries made in the books to the extent to which the financial statement is wrong.
Thank you very much. So if you look at the first part of the question, we're asked to advise on the appropriateness of the amount of 200 million, okay, that's captured in the financial statement. Okay. So let's just advise, we won't calculate anything. Looking at this question, I can see that they captured 200 million as provisions or contingencies. And they said when they investigated further, they discovered that the 200 million was made up of 20 million for court case involving a supplier, 70 million for advertisement rights, 50 million for future losses in business operations, 60 million for judgment debts. Okay. Okay. Even just me looking at it without even giving us so much details. I know that yes, 20 million, depending if they give me further details, it can go for provision. 70 million for advertisement rights, they cannot make provision for this one because this is even an asset for them. It's like the credit bank debit asset is an intangible asset. They cannot make provision for future operating losses. Yes, they can make provision for judgment debt on appeal. There's a judgment debt on them which they have appealed, so they made a provision. So this one is okay. So if I want to answer the first part of the question, say I should advise. So I will state that provisions can only be made where this 3 criteria are met. Number 1, there is a present obligation as a result of past events. Number 2, it's probable that outflow of resources will be required to settle the obligation. And number 3, the obligation can be measured reliably. So, following from the above, it is not appropriate to recognize the entire amount as a provision. So I cannot tell them how they should treat it here, because even looking further, they said I should discuss the treatment. This is in this, if I'm telling them how they should treat it, the right way to treat it, then I'm jumping. Now, come on, what will I then write in? So this gives you your 2 marks. It's just to tell them the basis for recognition of provision. That's your advice to them. That's your professional advice. Then the second one says you should compute the correct amount of provision. So the 2 says compute the provision. Again, I've already identified the 2 that can come in as provision. Number 1 is that's relating to the court case. The court case involving a supplier. And that was how much? That was 20 million. That we can and also the one relating to judgment debts on appeal. That is relating to this 60 million. That means the total amount of provision is 80 million. And then need to tell them that note that the above computation is based on the assumption that the 3 criteria have been met. The 3 criteria mentioned above have been met. Okay. The third one says I should discuss. I didn't say compete, say discuss. Okay. So Sarat, you can ask your question if it's very urgent. Sarat? Okay. She's ready.
Not very urgent. I just want to ask that when we are giving this sort of advice, hello.
Yes.
When we are giving
Yes, I'm
this
with
sort
you.
of advice, does this type of answer suffice, or we always have to write it like a letter or memo?
Yes, this kind of
Do you
answer
get?
suffice. Yes, I get your point. So this type of answer will fly. Can you hear me?
Yes, because they say advice on the appropriateness. So I was wondering, do we have to write a letter, anything?
No, you don't have to write a letter. So If
Okay.
they want you to write a letter, you would see questions like that. They will ask you to write a memo. They will usually call it a memo. If they just ask you to advise,
Okay.
please don't do a letter. Of course, we'll still solve. Probably maybe we have done something like that in the past, but this works fine.
Okay, so also they said 50 million provision for future losses. So we cannot make provision for future losses until that loss actually happens. Right.
Yes. Yes.
Okay. That's all.
All right. So this third one is saying we should discuss the treatment of the previous entries made in the books to the extent to which the financial statement is wrong. So they want us to tell them the treatment of the entries for those that we feel that is wrong, right? So we would say that how much is that advertisement right again? The 70 million naira paid for advertisement rights should be recognized as an intangible asset out provision because in this case the entity does not have any present obligation, but rather it can generate economic benefits from the advertisement rights that's paid for. Additionally, how much for future operating losses? 50 million for future operating losses. Additionally, the 50 million for future operating losses should not be recognized in the books because should not be recognized in the books because there is no present obligation and the amount therefore does not qualify under any elements of financial statements. Know that the amounts recognized for the court case and the judgment debts in appeal can only be recognized as a provision if it meets the three recognition criteria for provision recognition. Okay. So that's for this. So we have showed them how they should treat it. And the one they should not even recognize in the books at all, which is the future operating losses. And that's the solution to this particular question. Any questions? Okay. There is another one also in May 2025. And that is talking about explaining the term provisions, contingents, and stating clearly the recognition, the criteria for recognition and measurement of each. So we are done with provision, but I'm not done with contingent liabilities and contingent assets. So let me quickly mention contingent liabilities and contingent assets. So a contingent liabilities, or let me put it singular, a contingent liability is a possible obligation arising from past events, the existence of which will be confirmed by the occurrence or non-occurrence of one or more uncertain future events that are wholly outside of the control of the entity. So that question, when they are asking you to explain contingent liability, you should be able to give them this definition, that a contingent liability is a possible obligation. This is different from a probable obligation. Okay, this is a possible obligation. So possible is like the possibility of occurring is very remote, that it might not happen. There's the likelihood of it happening is very low. So a possible obligation. And that's why they say that the existence of which will be confirmed by the occurrence or non-occurrence of one or more uncertain future events. And these events are not within our control. Okay? It can also be defined, so you can choose any of these definitions. It can also be defined as a probable obligation arising from past events, but which is not recognized in the books because, one, it is not probable that there will be an outflow of resources burden economic benefits required to settle the obligation. And two, the obligation cannot be measured reliably. So you can also define it this way as well. So either one is fine for you in the exam. So following from the definition above, contingent liabilities are not recognized in the books, but are only disclosed in the notes to the financial statement. So we don't expect you to recognize a contingent liability in the books. You just tell us about it. So that goes to show that any item that you can prove to us that there is no provision for it. So most likely than not, you will just say, okay, that would be a contingent liability. And that means that for you to even say it is a contingent liability, there must be an obligation. The only reason why you cannot recognize it in the books is because we might not pay money. It's not probable that we'll pay money as of now. The obligation cannot be measured reliably as of now. Okay, so for that reason, just disclose it in the notes. And the disclosure, what you're showing us, the disclosures, number one is you give us a description of the nature of the contingent liability. So you tell us about either the obligating events or just let us know. And also you let us know the financial impact, the future financial impact of the contingent liabilities. If there will be any financial impact involved, you will let us know. And you also let us know about the uncertainties surrounding the amount required to settle the obligation. Okay, so this is contingent liabilities. Do you have any questions? Before I move to the last one, contingent
Yes,
assets.
so I have
Yes, sir.
question.
The first definition he said is a possible obligation arising from past events. The second one, he said is a probable obligation arising from past events. I don't know.
Oh, yes. So, so the way we are looking at it is that the standard gave us two definitions. Either one can fly. So this first definition is actually saying that the obligation that is in existence right now is the occurrence is just very low right now. We cannot say is less than 50%. That's what we mean by a possible obligation. So this first definition is all around the fact that the obligation is so uncertain and the likelihood is so low that the existence would only be confirmed by the occurrence or non-occurrence of one or more uncertain future events. It's just like a court case. There's a court case happening, but you're just starting and we don't know. Like, if they say the likelihood of we paying is just is remote, is very small, is less than 50%, but there's a court case, there's a possible obligation, like there's an event happening, but the existence of which will be confirmed by the occurrence or non-occurrence of one or more uncertain future events. right? So when you have a court case that you don't even know what the outcome will be right now, that you don't even know whether you settle or not, that's a candidate for contingent liability. And in another way, you can look at it as, okay, the obligation is a probable one, meaning that still a court case, we have an obligation and is looking up, is probable, but right now, we don't know whether we will pay. In fact, it's still very low that we will pay. The probability of us paying, we know that there is an obligation because the case is ongoing, right? We know. But the lawyer handling the case is telling us that there's 30% chance that we will pay. There's 30% chance that we will pay. And we don't even know how much we would settle like that. So, I mean, the standard is just playing around with words. So, depending on which one is comfortable for you, in the exam, you don't have to give them these two definitions. Just stick to one and go with it. But they are talking about the same thing. Each of them is talking about that, yes, there is an obligation. And the outcome is based on one or more certain future events, or there is an obligation and it is not probable that we'll pay money and we don't know how much. So that's what that's looking at, really. I hope I tried to answer your question.
Yes, sir.
Okay, I think I have a...
question.
Okay, please ask, Charity.
So, the normal definition of liability is that there is an obligation as a result of past events that money will surely go out from the company. But then this definition is saying that it is not probable. When it's not probable, that means it's certain now, Abi. When the probability is not there, that means it's certain. I'm confused.
I know if they say that it is probable,
Mm-hmm.
it means that there is like above 50% chance that you will pay.
Yes.
Hmm?
Yes.
If they not say that it is not probable, it
Probable.
means that there is less than 50% chance that you will pay.
But
It's
then
not.
it is liability.
Yes, it is. They called it a contingent liabilities, but you know that we have mentioned that because it's the probability of us paying is very low. That's why we said don't recognize it in the books. Don't put it in the books at all. You can
Yeah.
only disclose it in the notes to the financial statement. They are only disclosed. And I've told you what disclosures you make on them.
All right. So thank you.
Yeah. Any further questions? Now, so the final thing here is contingent assets. Contingent assets. So for contingent assets, we say that this is a possible asset. This is a possible asset that arises from past events, the existence which will be confirmed by the occurrence or non-occurrence of one or more uncertain future events, in fact, that are wholly outside of the control of the entity. So for contingent asset also, the definition is similar to that of contingent liabilities. And this one is also outside of our control. So note that contingent assets are not recognized nor disclosed in the books. So we don't even want to see it. If it's a possible asset, you don't even have to put it in the books at all. There's no need, right? Contingent asset. So in fact, for assets, it's only when you are sure that you realize it, when it is probable. When it is a probable assets, then probably maybe you can disclose it. And when you are sure that you would generate future economic benefits, then you can recognize it. So you can disclose a contingent asset if the realization of the benefits becomes probable. And when it becomes reasonably certain that future economic benefits associated with the assets will flow to the entity, then you can recognize the item as an asset. So you would hardly find contingent assets in the books, because as far as asset is concerned, it's either it will generate benefit or it will not generate benefits. So the issue of disclosing itself, you hardly find it in the books. So if it's contingent, just don't disclose unless the realization of the benefit becomes probable. Then you can disclose, you can actually tell us that, okay, you are looking at procuring an asset, something like that. But as soon as you have the assets, that you have control over the asset, that's when it becomes reasonably certain that maybe you have a PP, you have an intangible asset. That's when you recognize it. So contingent asset is really nothing. So the best the examiner will ask you of is the definition, like that. Okay. So that's that for contingent assets. Do we have any questions? Okay, Femi, let's
Please
read this
bring it
question.
down small. It's okay.
Okay, Femi, let's read that question, please.
Okay. A company knows that when it sees a certain operation in 5 years' time, it will have to pay environmental cleanup cost of 10 million naira. Determine the provision to be made in the current and the next year using a discount rate of 10%.
Okay. So this company knows that it's when it ceases certain operation in 5 years, it will have to pay environmental cleanup cost of 10 million. So how much is the provision? So here, it's just the present value. So the provision here is just the PV of that 10 million. So that's 10 million into bracket 1 plus 0.1 raised to power in the next how many years? 5. What would that give you?
0.9515.
The 9 point.
Okay, I'm supposed to multiply by 10.
Yes.
Okay. That would be 9.5.
Okay. So this one is saying that what you're learning here is when the amount you are paying is much later in the future, then you need to discount it to present value. That's just the major thing here. Okay, let's look at the next question.
A company was sued by a customer in the year ended 31st December 2015. Legal advice is that the customer is virtually certain to win the case, as several similar cases have already been decided in the favor of the injured party. At 31st December 2015, the company's lawyer was of the opinion that the cost of the settlement would be 2 million naira. You are required to recognize the provision in the book of accounts.
So this one is quite straightforward. Are we going to make a provision here or not? Anybody?
Yeah.
Yes, quite straightforward. So since the lawyer said we'll settle 2 million, and we already know that the customer would win based on experience. So provision that will be recognized is the 2 million naira. So just recognize 2 million because it meets all the recognition criteria. Recognition. It meets all of them. So let's look at this next one here.
Sir, wait, please. You know that first question, I did not get the answer. Oh.
What did you get?
I'm getting
Sir, I got
6.209.
6.2.
This 9.5.
Yes, sir.
When you do 1.1 raised to power minus 5 multiply by 10, you got 6.5.
6.209.
Yeah, 6.209.
6.209. So where did Femi now got this 9.5?
The 9.5 is actually correct, sir.
No.
You are doing raised to power 5. It's raised to power minus 5, not 5.
It's raised to power minus 5 I did.
Yes, that is 1 point. Look at what you are doing now. Check it very well. It's 10%. So you are doing 1.01 and not 1.1.
No, you are doing 1.1.
It's 10%. So 10 divided by 100. Okay, that's 0.1. So, okay. Then this 6.20 is correct.
6.209.
This 6.209 is correct.
Thank you. Yeah, let's continue, please. Femi, please, let's read this next question.
A company has constructed an oil rig which became operational on 1st of January 2016. The company has contracted to remove the oil rig and all associated infrastructure and to restore the site to repair any environmental damage to the site on completion of drilling activities. This is estimated to be at a cost of 8 million naira in 10 years' time. The entity cost of capital is 10%. Determine the amount of provision to be recognized in 2016.
Okay, so first, can we make a provision here first? Can we make a provision here? He constructed an oil rig, it becomes operational in 2016.
Yes.
Yes. Okay, yes, we'll make a provisions
Yes.
because there's a contract. Yes,
Under contract.
Yeah, so the provision calculation is now straightforward. It's just 8 million into bracket 1.1 raised to power minus 10. How would this give us?
Three zero eight four
3
346.
point.
It's not. Yes. 346. We didn't bring the 00 up now, so.
Okay.
Okay. What's the next one?
Okay,
What's
next
the next
question. During 2010, Sheriff Limited gave a guarantee of certain borrowing of Mags Limited, whose financial condition at time is that time is sound. During 2011, the financial condition of Maxwell Limited deteriorates, and at 30 June 2011, Maxwell Limited filed for liquidation. What account entry is required at 31st December 2010, B at 31st December 2011?
Okay, so this says that during 2010, Sheriff Limited gives a guarantee of certain borrowings of Marix Limited, whose financial condition at that time is sound. During 2011, the financial condition of deteriorates at 30 June 2011, and it filed for liquidation. So what was the country treatment of this in 2010 and from this in 2011? Okay, let me give you opportunity for us to discuss this. So what will you recognize in 2010 and what will you recognize in 2011? Anybody?
I don't know. Would there be provision for bad debt?
Okay. So which of the years now? Is it 2010 or 2011?
There's to be 2011.
Okay, so at 2010, the financial condition of the of Mix Limited was sound, and the guarantee given will be disclosed as a contingent liability, because even though there is an obligation, it is not probable. It is not probable that there will be an outflow of resources to settle the obligation, and the obligation cannot be measured reliably. So in 2010 now, the financial condition of the guy is sound. And remember, we gave a guarantee. Probably the guy went to borrow money, maybe from a bank. We are now standing in as a guarantor. So yes, that's an obligation. That's an obligating event. But his financial condition is sound in 2010. So as at 2010, it is not probable that there will be an outflow of resources to settle any obligation, and the obligation cannot even be measured reliably. So we'll disclose, to be disclosed as a contingent liability. But you see, at 31st December 2011, we have to recognize a provision as it is now probable that an outflow of resources might be required to settle, and the obligation can be measured reliably because makes financial condition as deteriorated. So that's the solution to this one. Do we have any questions? Any questions?
There is no like a question, but like an observation.
Okay.
So this question now explains to us that contingent liability is I don't know how to explain it, but like maybe when a business is still sound, but then there is a disclosure that they will liquidate, you you disclose it in the book as contingent liability. But when the business has English is hard. When the business has deteriorate, you can now make provision for it, right?
Yeah, so I can see you're trying to get the difference between contingent liability and provisions. So you see that from this question now, Sheriff Limited went to stand in as a guarantor to a company, and of course the company is doing well. The company is guaranteeing, is doing well. They are fine. But the fact that he's standing as a guarantor means that there's a risk that it's possible that he might default. And when MAX default, it's me, Sheriff, that they will come to. So an obligation exists, but for the fact that MAX financial condition is still sound, it means that the likelihood that I will pay is not probable that I will pay any money. All right. So for that reason, you only disclose. Now that's a typical meaning of contingent liability. Because yes, I've entered, there's an obligation, either possible or probable. There's an obligation, but it's not probable that I will pay money because the guy is doing well. So I'm not even thinking of, but I need to disclose it in my books as a contingent liability because the existence of that liability is dependent on the existence or the occurrence or non-occurrence of one or more uncertain events that is outside of my control. That's a contingent liability. Now, we then have to make a provision because now the his condition has deteriorated. The bank might likely come to us and say, "Oh, yeah, Oga, you were the guarantor, yeah, pay money." Now it is probable that we might likely pay money. So then hence you have to make a provision. Okay, so this question is good in such a way that it helps distinguish a contingent liability from a provision. So it's just from the standpoint of are we paying money? Are we not paying money? If it's a contingent liability, it's not clear. In fact, it's so clear that we won't pay because everything is going fine, but there is an obligating event. We have entered into it. We have done something, but it's not clear that we'll pay money. But at the point where it is most likely than not that we'll likely pay, like in this case, this guy's financial condition has deteriorated. He has even filed for bankruptcy. Now it is probable that we'll pay money. So we need to recognize the provision in the books. Yeah, good question, Charity.
Yes, sir, please. I also want to confirm something.
Okay, Semiat.
Yes, so in a situation whereby they did not include that the company has filed for liquidity, are we still going to recognize it as contingent liability and not provision?
Yes, sir. You still recognize it as a provision, not contingent liability, because his financial condition has deteriorated. Even without filing for liquidation, is more likely than not. His condition has deteriorated. So you still recognize the provision. So it's now clear that you pay money. Even though we are not saying it's 100%, but at least it's probable. That's why they said it is probable that there will be an outflow of resources embodying economic benefits. Sure, you get.
Yes, sir.
Hello?
Yeah, I'm with you.
So, will you say it's a bad debt for sheriff?
For sheriff, bad debts. Is anybody owing him money? No.
Oh.
Nobody is owing him money. So it's not a bad debt. So it's just a provisions for a liability that he has to incur. So I won't say it's a bad debt for him.
It's just an obligation.
Yes, that he has to make provision for. He wants to stand in as a guarantor for somebody. It's just like you went to borrow money in the bank. You now say, "Can I be your guarantor?" You now came to me. The bank say, "Go and bring a guarantor." Me, I now came and said, "Okay, I'll be your guarantor." So if you now fail to pay, you know that they will come to me. So as soon as I'm seeing that your financial condition has deteriorated, I will just make a provision in the books that money you are owing, they are coming to meet me. I will recognize that amount, debit expense, credit provision. So,
Okay.
however you want to describe it in the books, it's okay, but at least just know that it's a provision. You can call it whatever name you want to. You're not really bothered about description of items in the books, but there's some key classification that you need to get right. If you want to call it provision for doubtful debt, when the auditor come, they can help you reclassify it properly, but it's a provision. More questions, more questions. Okay. Good that you guys are asking questions. I mean, if you continue like this, the exam will be so easy for you. Okay, Femi, let's look at this next one.
Webley Limited give warranties at the time of sales or to purchaser of its product under the term of the warranty. The manufacturer undertake to make good by repair or replacement manufacturing defects that become apparent within a period of 3 years from the date of the sale. Should a provision be recognized?
Okay, so this is an open question, and they want to know whether we should recognize a provision here. So we gave a warranty. We give a warranty at the time of sale to purchasers of our products, and we are going to make good any repairs that becomes apparent within a period of 3 years from the date of sale. Should we make a provision?
Yes.
Yes.
Because I think it's
Yes, he's going to make a provision for this. And if you want to answer a question like this in the exam, you just tell the examiner that yes, he makes a provision because there is a present obligation, that warranty that he gives to his customer, and it is probable that there will be an outflow of resources and we can measure it. So even though they didn't give us like complete information, but you still are going to make a provision. They didn't give me complete information as to whether there is probability that there will be any default, maybe from past experience and all of that. But I will still tell the examiner that I don't have sufficient information to know whether it is probable that there will be outflow of resources. I don't know, because for me to decide that, they will have actually told me that maybe from based on past experience, so for every 50 that we sell, let's say 10 will require repairs. For every 5 that we sell, 2 something like that. But here it is not stated at all. So if I want to answer a question like this in the exam, I'll probably tell the examiner that Webley can make a provision if the 3 criterias below are met. And what are the 3 criteria? there is a present obligation as a result of past events. Number two, it is probable that an outflow of resources will be required to settle the obligation. And three, the obligation can be measured reliably. Okay, so if these three are present, then yeah, but from the question, it is only apparent that there is an obligation because the entity gave a warranty. We cannot determine whether it is probable that there will be an outflow of resources. Hence, if the other criteria are not met, the entity can only disclose a contingent liability. Okay, that's how I'll have answered this question. So we have spent 2.5 hours here, so I can achieve my target for today. So let me allow you, I've done the major questions here. Let me allow you try question 3 as assignment, which is the last question here. Let me give you opportunity to try that. These ones are very simple questions. Just explain. I have solved these ones for you. I have solved this November 2023 for you. I have also, this November 2022 is a very straightforward question. They said distinguish between provision, contingent liabilities. Very straightforward question. And 2021, you can solve it yourself, but it's a similar question to that one, but you can just try your hands on it. So, and I need you to also try this one. Let's see if you can distinguish, because this question, see, they give you 14 marks. It means that you must tell them everything you know about provisions. Don't just define provision. You get 0, maybe you get 2. But you need to tell them provisions, definition, the recognition, measurements, contingent liabilities, define it. You tell them that, okay, you can only disclose it. Contingent asset, define it. Tell them you don't even need to recognize anything unless the asset is probable, like that. You need to tell them, give them all the details so that you can maximize your mark. Okay, so with this, we have fully covered provisions. I've taught you everything that is necessary for you to know in this topic. It's now your duty to ensure that you'd revise. And this working note I'm giving you is so good for you. Like, I mean, you can just use this along with your video, and you might not even have to bother about any big handouts again. I mean, this is like a summarized version. Even though by the time you accumulate everything, it will be running into a lot of pages though. But I mean, this is just very good for you. Use it for your revision, use it well. So we won't be able to cover IAS 10 today. I don't do too long hours. It won't be effective anymore. So I'll communicate with you guys on when we are going to be tackling IAS 10. But I can tell you for a fact that what we have immediately in front of us, I have 4 standards right at the top of my head that we need to cover as quickly as possible. I have IAS 10. I have IFRS 15 on revenue. I have IAS 8 on accounting policies. And I have IFRS 18 on presentation of financial statement that is replacing IAS 1. Those 4 standards are my priority for now. Let's see how far we can go with them in the next 1 or 2 weeks. If we can finish them in 2 weeks, then that's so perfect for you guys. Then what we have left are just very scanty standards around, and of course, group account as well for us. But those 4 are very, very, very important because there are a lot of them in your exams like that. So I will let you know our other plans, but the likelihood of us having any further class today is low. For my other class I'm supposed to have at 7 p.m. today, that is not going to happen. This will just cover up for that. So you guys should have a wonderful time ahead of you today. Bye-bye.
Thank you, sir.
Thank you.
Thank you,
Thank
sir.
you, sir. Thank you, sir.